Hello everyone, welcome to Module 1 of the Steve Huffman Financial Literacy Package, What to Do While You Still Have a Job. This module will be broken down into 3 sessions: Legal, Foundation, and Administrative. And the purpose of this module is to help guide you through the items that you need to consider and have up and running prior to you leaving your job and starting your new endeavor on your startup. Ultimately, the goal of this module and all these sessions is so that you have everything in place that when you do decide to leave that job and start your startup, you can just literally flip a switch and everything is off and running. So that's what we're designing this aspect to do. So the first session, legal. In this session, we will review organization structures. Now, when you set up your business, you're going to need to be able to understand what kind of structure you want to have in place. Do you want a sole proprietor, partnership, LLC, corporation, what have you? So we'll go over those aspects in here. Legal documents. Now, this is going to be the most important thing of this entire session, and that's why this session's titled Legal, is to go through those respective documents that you need to have set up and in place, not only for the startup of your company, but protect you and your company as it progresses throughout the years. Employer Identification Number, or the EIN. We'll walk through that process with you as well so you can get an understanding of how to get it and really how easy it is to get that respective EIN number. Then the last items: tax return deadlines, licenses, insurance, and other taxes. Again, you're starting up a business, so a lot of these things will be new to you if you have never operated a business before. So first thing, organization structure. We need to help you determine which structure is best for you. The first item is sole proprietor. Now, sole proprietor truly is a one-person show who may or may not be incorporated and registered with the state as an LLC, a limited liability company. The big thing with a sole proprietor is you risk not only business assets, but your personal individual assets are at risk for any decisions you make. So within the business environment, if you're a service organization and you give bad advice, not only your business assets will be at risk, but your individual personal assets could be at risk should a lawsuit come at you. One of the benefits of a sole proprietor is your individual tax return. You only have to really file a Schedule C for your business, which is a separate schedule within the 1040, possibly Schedule F if you're a farm, or possibly Schedule E if you're doing rental income. But you don't have to file a separate tax return. That's all going to be encompassed within your 1040. The next item is partnerships. Now, partnerships, just to be clear, a partnership can be a partner with individuals, corporations, trust estates, and other partnerships. So it's you and some other person or entity. The uniqueness with a partnership is each partner contributes something to the organization so that they can share in the profits and losses. And the beauty about a partnership is if it's you and another partner, and you're contributing cash, and the other partner, is hard up for cash, but they have the skills and equipment necessary to get the organization running, they can contribute that as part of their contribution to the partnership. And so that's the uniqueness about the partnerships, is you can have one person contribute cash and somebody else contributes skills and labor and possibly equipment so that you can get the business up and running. Now, one thing that is unique to partnerships and also to S corps, which we'll cover in just a second, is they are considered by the IRS as pass-through entities. And what that really means is when you have your revenue and your expenses that you earned on a partnership, that passes through to you, the individual, based on your percentage. So a partnership from a federal standpoint is not taxed on business tax. So when you have let's say $100,000 in net income for the year in a partnership, the partnership doesn't pay tax on that $100,000. That $100,000 will flow through to you as the individual. So if you own, let's say, 60% of the partnership, of that 100,000, you get $60,000 of income. That flows through to your individual tax return, where you will pay tax on it on your individual tax rates. And the way that flows through is through what's called a K-1. Now we'll go over the respective tax forms in a little bit, but with a partnership, you will file what's called the Form 1065, and it's strictly just a tax return form designed specifically for partnerships. And when you get done with the tax form and you've put in all the inputs of the income and expenses and all the assets and liabilities, you'll get what's called a K-1. Each partner will get a K-1, which is just a formal form that breaks out, okay, partner A, here is your percent of the income that you need to take to your respective personal tax return. The next item is corporations. Now, there's multiple types of corporations out there, but the two most prevalent ones are what's called a C Corp and an S Corp. Now, a C Corp, that is traditionally going to be your public companies, your IBMs, your Apples, your Walmarts. They are traditionally going to be a C Corporation. Now, you don't have to be a public company to be a C Corporation. However, if you are a C Corporation, your income is actually taxed at the business level, at the corporate level. And so that creates a bunch of headaches for individuals who do set up C Corps. They have the tax at the corporate level, then the distributions come out, and then you get taxed again. So that's why, if you've ever heard C Corp double taxation, that's kind of what they're talking about in that aspect. But for our purposes, we're going to talk about an S Corp. A lot of times it's called a subchapter S Corporation. And what it is, in a nutshell, it's like a partnership, except for instead of having a percent ownership like you do in a partnership, you actually will own shares of stock. So if you set up an S Corp, you as the owner may have 100 shares, and you may have somebody else who buys in, and they may buy 50 shares. One of the things I've always recommended to my clients over the past 20 years is, if you set up an S Corp, you're going to have a certain amount of stock or a certain amount of shares. You're going to say, okay, there's going to be 1,000 shares in this respective S Corporation. Do not issue all 1,000 shares, or do not issue all the shares of the stock. I've seen that before, and the problem is, when you do that, you restrict your ability to raise capital through equity. So in other words, if we have 1,000 shares and total 1,000 shares available, and the people who own the company have 100 shares. That means they have another 900 shares that, if they want to do expansion or they want to bring on a new person, they have that 900 shares where they can issue them and raise more capital through an equity process. And so that's why we always say, don't always issue all your shares that are available. The other thing is, with your shares, you're going to set a par value. Now, par value is just something written on the actual certificate, if you issue formal certificates, and you're going to indicate as to whether or not it's going to be $1, $2, $3, $10 par value. Although sometimes a lot of times you will see non-par value. Now, non-par value is, what it says is, there's no amount assigned to the individual shares. That doesn't mean the shares are free or worthless. That just means you haven't set a par value to it. So my own personal standpoint is, the best way to go about it is do a $1 par. However, you want to talk to your local legal counsel, your local attorney, as to, there may be specific rules in place on where you live as to what you should have on that respective par value. But my own personal preference is, if you have $1 par value, that makes the accounting for the stocks that have been issued that much easier. Because if you have $1 par and you purchase 100 shares, well, your journal entry on your equity section is going to be common stock $100, because you get 100 shares times $1, $100 there. And so that makes it easier to track as you go through, because you may have shares purchased, shares bought back in treasury stock, so on and so forth. So that just makes your life just a little bit easier from an accounting standpoint. The next item, limited liability company. Now, an LLC, as it says, that there's limited liability to the company. And these are predominant, you see a lot of LLCs nowadays, and it's really kind of your basic protection for the individuals of the company. Now, ultimately, an LLC really functions like a partnership. So even though it's an LLC, usually you're going to file a Form 1065 for your partnership, and you're going to have owners. Sometimes you'll have what's considered member units. Instead of ownership percentage, you have member units, but it really functions just like a partnership. You can have a corporation that's an LLC, but predominantly what you see is people have it as a partnership, and they file a Form 1065, no different than if they were just a regular partnership. Now, one of the uniqueness about this is you'll hear the term disregarded entity. And what this means in a nutshell is with the IRS, if it's just you who owns the LLC or you and your spouse that owns the LLC, you can treat the LLC for tax purposes. You can treat it as a disregarded entity and file all the information, all your income and expenses on the Schedule C of your personal 1040 tax return instead of filing a Form 1065. Now, me personally, I've had a couple LLCs, and a lot of times I could have been treated as a disregarded entity, but for personal reasons, I chose to file the 1065, which is the partnership tax return, because it just gave me more separation between personal stuff and the business stuff. The beauty about a 1065 is one of the schedules within there is you have to put in your balance sheet. That's part of the tax return. With a Schedule C on your 1040, your personal tax return, there is no place to put the balance sheet. So being an accountant, CPA, forensic accountant, I like to be able to track this information. Even though I've got accounting records, it's nice to also have that in the tax return. So that's why I personally prefer to do the 1065 for an LLC, even though I know that that's not technically required based on my own personal situation. Now, if it's you and another partner and that other partner is not in any way, shape, or form related, you won't fall into that disregarded entity part. So don't think you'll be able to do that if there is somebody outside your immediate family that is a partner in the LLC. Next, now this is the most important thing of this entire module as we go through this, is the setup of the legal documents. The first item is pretty mundane, the articles of organization or articles of incorporation. Obviously, if you're going to be a corporation, you're going to be incorporated. If you're not, you're going to be an article of an organization. And this is really just the standard template mundane items regarding the business. The biggest item is operating agreement. Now, I'm a forensic accountant, and I've done several investigations, and every time I investigate a partnership, when there's an issue between the two partners, one of the first things I always ask for is the operating agreement. And like clockwork, I always almost know what the answer is going to be, and usually it comes back and they say, well, there isn't an operating agreement. Well, without an operating agreement, that puts the onus of verifying who should have 50% ownership, how much did somebody contribute, so on and so forth, goes back onto the two partners. And if you have one partner that's mad at the other partner and they're suing each other, without this operating agreement, it just makes everything muddy. And without it, you don't have the protection. If you are the partner who had fraud committed against, you don't have that protection in place. So I always recommend that you consider getting an operating agreement. The reason being is, first off, you want to clearly dictate in the operating agreement what the profit and loss allocation will be. So sometimes you may have somebody, if there's two partners and one partner contributes $50,000, the other does skills and labor and equipment. Well, sometimes what happens, and I've seen this happen, where the person who contributed the cash, at first they may do a 50-50 split, but then after a while, all of a sudden it becomes a 60-40 split, and the person who contributes cash says, well, no, I should get more because I contributed cash. Well, without that operating agreement in place where they specifically say who's going to get what, that makes it hard for the other partner who contributed, the skills, labor, equipment, to be able to come back and say, no, we agreed to the 50-50%. So That's one of the big things in your operating agreement. You immediately set forth, pretty much before you even start day one of selling whatever you're going to sell, you have it in place saying who's going to get what the break and what the breakout percentage is going to be. The other item is capital contributions. So let's go back to that example I just gave. If you have one partner who gives $50,000 in cash, and then the other partner is contributing skills, labor, and equipment necessary to get the company up and running, you need to make sure that you, at that point in time, when everything comes in, is you indicate as to, okay, here's the skills, labor, and equipment that partner B is contributing, and we're going to say that this truly is 50% ownership within the company. And so you put a value on that. So if we say, okay, the value of all this labor, skills, equipment that partner B is contributing is the equivalent of $50,000. So if you have that spelled out in the operating agreement, that protects that partner who didn't contribute the cash. Because I've seen it go, you get down the road and all of a sudden that partner does not have anything that they can show, even though they put blood, sweat into the organization, they put their sweat equity in, there's no, check that you can trace it to. There's no dollars being brought in. And so put that in place into the operating agreement. And one other thing that's not listed on this slide to consider is how are you going to buy out partners? And specifically, how are you going to buy out a partner if they pass away? A lot of times you can see where you have two partners and 3-4 years down the road one of the partners passes away and his ownership transfers over to his estate. Well, we want to make sure we protect that estate, that even though that partner is gone, his estate should be properly compensated for that partner's ownership interest. And so what you want to do is just have a very generic setup to say at any point in time when a partner is being bought out, a valuation will be done by a certified valuation analysis, and at that point in time, whatever the values come out to be, then that partner's estate will be bought out. You also want to make sure you have something in there that if a partner just wants to step away, they're tired, they want to retire, they want to go do something else, that they're protected as well. They say, if at any point in time you decide to leave the organization, your shares will be purchased back at a fair market value determined as of XYZ date. The beauty about all this that we just went over in the operating agreement is that you can make changes to this at any point in time. You can always make an amendment. If at a point in time, in the future, 3 years down the road, that partner contributed 50,000, all of a sudden is going to fork over another 100,000. You can say, okay, for that extra 100,000, we're going to change the allocation from 50-50 to 70-30, what have you. So that's the beauty about this, is you can always amend it down the road. But if you don't even have it in place, you don't have that protection in place. So that's why this is one of the biggest things you have to make sure you concentrate on when you're setting up your company, is you have this in place. Again, it's really just a safety blanket to start with. You can always amend it as you go down the road. Then the next thing is you want to make sure you register with your respective state. Now, doing the registration is, in some states, it costs $10. Some states it's like $50. It's usually not that onerous. You just need to make sure you're registered with those respective states. So keep in mind you will probably need to do that. The next item is LegalZoom. Now, I'm sure many of you have heard about LegalZoom. And I in no way, shape, or form am compensated from LegalZoom about talking to them about them. I just have personally used them on some of my businesses, and I find that it is very affordable way and quick way to get everything set up within your organization. Get these articles, get these operating agreements put in place. Now you still have the option to go to your local attorney and have them draw up the papers. I've just used LegalZoom because for about $200, $250 I can get all this set up and ready to go, and I can just then concentrate on other things down the road. So there will be a separate training series on how to go through LegalZoom. I just wanted to kind of throw that out there for right now so everybody could see that. Now the next item, your employer identification number, otherwise known as your EIN. You need to apply for EIN. The reason being is you're going to, even though you may not have any employees, you may be saying to yourself, well, why do I need to have an employer identification number if I'm not going to have employees? The reason why you want an EIN is your tax ID is going to be associated with a lot of documents that you file, both with the IRS, with your local municipality, with your county, with your state, what have you. Any kind of government agency that you have to file certain tax forms with will have some sort of identification number, and you really don't want to have your Social Security number on there. So that's why you apply for your EIN. And also with your EIN, that allows you to be able to open a bank account under your company's name. Now, some banks do still allow you to use your Social Security number under your respective company name, but for the most part, from what I've seen, is a lot of times they will ask for the EIN so that they can go through the process and get that set up. So, as you can see, here's the website for getting to the IRS and getting to their EIN. So let's go ahead and walk through the process on putting together the EIN. So here we are on the IRS website to apply for your employer identification number, or your EIN. Now, this website is really self-explanatory. As you can see, they go through each of these respective steps with you as you go through the process. And again, as we just mentioned, when you're applying for our EIN, you need to make sure you have your Social Security number available. This is also why when I talk to people and they're talking about setting up their business and getting their EIN, is if you're setting up an EIN for someone else, they need to give you their Social Security number. Don't use your Social Security number. The reason being is when you do that, you then become associated with that employer identification number. So if it's going to be your business, that's fine. That's what you want. However, if you're doing it for somebody, you want their Social Security number on there. Now, this is also how the IRS is able to determine that your business is associated with you, because this is how they're going to trace through the respective information. Is your Social Security number will be attached to that EIN. That EIN will be attached to all the filings that go through. So this is kind of the trail that they use to be able to identify this. So here I am at the website. Go ahead and click on Apply Now, Apply Online. First you'll see this disclosure that they have in here. I'm not going to go through that, but just keep in mind that disclosure will pop up. And the beauty of this website is pretty much every page they go through a bunch of information that allows you to make judgments as you're going through there to help you through the process. So go ahead and click on your Begin Application. And this is where, like we talked about, the respective structure of your company, and that was one of the reasons why we hit that first thing into this module, is so that when you get to this, you understand, what do I want as a company? And you'll see down here, estate and trust. That's not applicable to you guys, but if you ever do become a personal representative of an estate or a conservatorship, you'll have to get an EIN for those respective entities, but that's not really applicable to what we're doing. So for our situation, we'll just say we're a partnership. So we'll go ahead and click on that and go to continue, and then we'll indicate is it a partnership or a joint venture. For our purposes, we're saying it's a partnership. It's going to be myself and another partner in here. So click continue. And again, as you go through this, they have a bunch of these screens where they're going to go through and kind of walk you through a bunch of information so you fully understand what you're looking at as you go through the process. So it's really nice. So click next, and then why are we setting this up? Are we setting up a new business, our banking purposes, changing, what have you? In our situation, we'll say we're starting up a new business. So then we go ahead and continue. And then from here, you'll start entering the information. Again, here's where you have to put in your Social Security number, and you indicate I'm authorized, so on and so forth. I'm not going to continue after this point because it takes a lot of the information, and I'm not going to set one up. But as you can see, it does authentication, makes sure it's the address, goes over the details, and then get your EIN confirmation. And like I said, once you get done with this, usually pretty darn quick after you've finished, you'll get an email from the IRS saying, congratulations for your company, here's your EIN. And on the EIN form, it'll list out what tax form you need to fill out every year and what the due date is. And we'll go over the due dates here in just a second, but just be aware that if you're ever questioning, what kind of form do I have to fill out for my company and when's the due date, it actually says it there on the EIN form. And if you look at the workbook, I've taken a picture of an EIN that shows you kind of where that shows up. When you get the EIN from the IRS, usually it's going to come in an email. It's going to be a PDF attachment. Print out that PDF attachment and then also save that PDF somewhere that you'll remember where you saved it electronically. This then creates two copies, a hard copy for you and then an electronic copy for you. Now, I always do this because as you go through your business, when you first start it, you're going to use that EIN form for a lot of things, setting up your bank accounts, tax returns, sales tax, so on and so forth. However, what happens is, 2, 3, 4 years down the road, all of a sudden you need to apply for something and you need that EIN, and you specifically need that EIN form from the IRS. And so that's when it's good to have two copies so that you can remember where it is, whether you remember the electronic or the hard copy, you have that available. So that is the EIN. Like I said, very quick, very easy, and it's usually a pretty smooth process. So now let's go take a look at the tax return deadlines. Now that we have our EIN put together, we need to keep in mind we are probably going to have to file new tax returns that you may have never done before. And so depending on how you did your structure, you need to make sure you understand what form you need to fill out and what's the initial due date. So as you can see on here, we've listed out Form 1065, which is for a partnership. The due date is March 15th. The formal guidance says with the IRS 2.5 months after fiscal year end. Most people are going to be a calendar year, a 12/31 year end company, so 2.5 months is going to be March 15th. So the Form 1120S, that is a subchapter S Corp or an S Corp, again March 15th. And then if you're a sole proprietor, that follows the same guidelines as your standard 1040, as it would be April 15th. Now, keep in mind, this is as of 2019. These dates could change at any point in time. So I just want to throw that out there that as of 2019, these are the current due dates. Now, with all these, you can still get an extension. So I didn't go through the extension deadlines, but for your partnership, you can get an extension. For your 1120S, you can get an extension. I recommend, at least for your partnership or for your company, you try to meet the March 15th deadline or your 2.5 months after your fiscal year end deadline, because you want to get that done, organized, and off your plate. The other aspect is you want to make sure, and we'll see this as we go through the other modules, more specifically Module 3, you want to make sure your books are clean and closed as quickly and efficiently as possible. So if you're waiting 2.5 months after your fiscal year end, you still don't have your books cleaned up and closed, it's going to be very, very difficult for you to be able to make proper business decisions down the road if you're taking that long to get everything cleaned up. So that's why I might personally recommend getting it done. Don't worry so much about the extension unless your partnership or your S Corp happens to have an investment in another partnership and you're waiting on the key one for the information to flow through. Then you're kind of at the mercy of somebody else. So just keep that in mind, is you really want to be able to get through this and get it done, because ultimately you're going to be going through this process. So next item, licenses. Business license. Now, some municipalities require, some do not. You do want to check with your local town, city, county. If you live up in the Northeast, your village, check with them to find out if you have to have a business license. I actually live in a city where I don't have to have a business license for this city. However, there's 10 miles away from where I live, that city requires a business license. And the only difference, ironically, is the city I live in is actually bigger than the one that requires a business license. So make sure you check with your municipalities as to, do you need to have a license? Even though you may be selling online, you still need to make sure that that doesn't run afoul and run issue with that. Sales tax licenses. Now this is a big one. Now you need to be able to understand what is taxable in your town, city, county, state. So I live in the state of Colorado, and most places in the state of Colorado, food is not taxed. However, there are places within Colorado where food is taxed. So if I go to a grocery store and I buy some apples, where I currently live, I know I'm not going to get taxed on that, no sales tax. However, there are other parts of the state where if I buy those same apples, I'll get taxed because it's different within every city, town, county. And some states actually have sales tax at a state level. So make sure, one, you understand what is taxable, and two, also get your sales tax license, and then three, where do you need to submit this when you go through and you make a sale. So this is very, very important, because sales tax, if you think about it, your local government, that's outside of property tax, sales tax is one of their big revenue drivers, and they were very, very stringent on getting collections on sales. And so if you've ever seen on the news where an organization had the chains put on their door, well, that's probably because they were not remitting their sales tax. So you don't want to wind up in that situation. Now, online. If you're going to sell online, most states require you to file sales tax if you sell within your state, or what's commonly called your nexus. However, in 2018, South Dakota versus Wayfair, this went to the Supreme Court, and the Supreme Court ruled in favor of South Dakota. What this means in a nutshell is, going forward, you will have to collect sales tax on each state depending on the threshold. So this has made everything extremely complicated for small businesses who work online and sell online. So it's very important you go through and understand this. The genesis of all this was, in this situation was so South Dakota was making Wayfair pay sales tax in South Dakota. However, it had a huge impact on the entire country. And what's trickled down so far is that some states have thresholds. So a certain state, you may have to have over $100,000 in sales before you have to consider getting a sales tax. Some states say if you sell over 200 items, then you have to start collecting sales tax. And so it's become very complicated. And so one of the websites that I've gone through and reviewed is called taxjar.com. And in here I brought in their South Dakota versus Wayfair analysis. And there are various organizations out there that will help you with the sales tax collections, and they'll go through that mind-numbing process, because this is going to be very complicated. If the federal government doesn't step in and put something in place, this is going to be a huge headache, especially for the small businesses. So make sure you understand, one, is it taxable? And two, do I run afoul on any of this? So you just want to make sure you're fully aware of that. Now, insurance. Now, there are three main insurance items you need to consider for your business. First, business liability. This is just to protect you and your business. We're all human. We all make mistakes. If you make a mistake in your business, you want to be able to be protected if somebody comes back and sues you. Now, providing you weren't purposely misrepresenting or purposely committing fraud, for the most part, your insurance will cover you. So depending on what kind of business you're in, you want to go through and review the business liability insurance for your organization. Next item, life insurance. If you currently don't have life insurance on you, I highly suggest you get some. The reason being is you're working in an organization, you're going to start a company, and you don't want to leave your family with a gaping hole if something were to happen to you. Because keep in mind, if you were to pass away suddenly, they're going to have to find some way to, one, fill your shoes for your organization, but two, find a way to compensate everything. So that's why I highly, highly suggest you have life insurance in place. Now, I'm not going to promote any one specific life insurance company. There are multiple life insurance companies out there. What I will suggest is, when you start looking at them, a lot of them will have calculators that indicate what is the best or what is the type of coverage that you need to have. And a lot of times they'll just have a simple template there online where you can go through and fill out, and it'll indicate here's probably how much you need to have. So highly suggest you do that. Now, the third item is key man life insurance. Now, or key person life insurance. So what key person life insurance is you're having insurance taken out from the company on all the partners. Reason being on that is, if it's you and another partner and that partner passes away, What key personal life insurance does is it protects you, the partner, for that individual passing away, and so you're compensated to be able to make up for them. So life insurance, that's at your individual level to protect your family. Key person is to help protect you. If your partner passes away, you're able to keep running the company, because if you're in a two-person partnership and that one partner passes away, it's going to be up to you to fill not only your work, which is probably going to be quite a bit, but you're going to have to fill up your other partner's work. And so that compensation allows you either to recruit another partner or to be able to recruit an executive level individual, so it compensates you for that loss of a key person within the organization. Now, other taxes. Sales tax. We just kind of went over this, but this is extremely important. File your sales tax on time. Keep in mind, this is not your money, and you want to segregate it from your operating cash. So whatever your municipality says, if they say you file quarterly, monthly, biannually, what have you, make sure you understand when and that you file it on time. Again, this goes back to the part where you'll see companies with literally chains on the door, and it's because most of the time they didn't file their sales tax or they kept it for themselves. Governments do not like it when you do this, and they will come after you. So make sure, one, you file on time, and two, when you do collect sales tax, if it's a taxable item, you segregate that money for your operating cash so that it's set aside, so that when you do file, it just comes right out and it's not a problem. Payroll tax. Again, just like sales tax, file on time, and it's not your money. You need to keep it separate from your operating cash. Now, a lot of times people will use a third-party payroll processor to do their payroll. I would recommend it. It takes the headache out of all that process. If you do that, one of the well-known ones is ADP. They'll segregate the payroll tax for you, and a lot of times they'll help get that remitted for you as well as the respective payroll tax form. So keep that in mind. Is if you want to do it in-house, you're plenty welcome to do it, but there are a lot of possibilities of not getting the tax remitted on time. And again, the federal government is just as stringent as your local government on the taxes. Now, this concludes the first session. The next session, we're going to go over the business foundation, and this is where we're going to start talking about your bank accounts, capital funding, how to go through that process. So in the meantime, I hope this has been informative for you, and I will see you again on session 2. Thank you.